Monday started with deep opening gaps and geopolitical panic, but the session ended with a show of resilience. While headlines drove an early wave of selling, the S&P 500 found firm support at the 6,800 level, marking a significant intraday reversal for Wall Street. The morning's panic was driven by a sudden energy shock. Oil prices surged on reports of a Strait of Hormuz closure and strikes on Iranian facilities, an escalation headlines dubbed Operation Epic Fury. This geopolitical shift pushed the 10-year yield to 4.07% as traders dialed back rate cut expectations. But as the session moved into the afternoon, that initial fear gave way to the resilience we saw in the closing numbers. Early volatility was driven by a series of geopolitical shocks. Nana and 42 Macro reported on the effective closure of the Strait of Hormuz, while Joseph Carlson tracked breaking headlines regarding Operation Epic Fury and strikes on Iranian facilities. These events immediately pushed oil prices higher and forced markets to price in a significant escalation in regional conflict. While the energy shock and the spike in yields to 4.07% rattled the open, the market's resilience came down to technical positioning. Nana notes that the early panic evaporated as the VIX compressed from 25 down to 20, allowing institutional sellers to drain the fear premium, even as traders scaled back their rate cut expectations. The market's resilience through the opening shock was largely driven by technical positioning. According to Nana, early session panic evaporated as the VIX compressed from 25 down to 20. This cooling allowed institutional sellers to systematically drain the fear premium from the market, which helped stabilize the tape. According to Nana, the market's resilience is anchored by dealer gamma at the 6,800 level. This creates a mechanical floor where market makers are forced to buy the index to hedge their positions. Looking up, a wall of call writing between 6,900 and 7,000 acts as a firm ceiling. Without a major surprise to the upside, these technical boundaries are expected to contain the current price action. Energy prices jumped today, but the real debate is about what's actually driving the move. Eurodollar University points out that wholesale gasoline surged over 17% in just 2 days. Yet they argue this is almost entirely a logistics shock rather than a permanent shift in demand. We're seeing this reflected in the bond market as well. Treasuries are repricing for a hawkish Fed reaction to these higher costs, rather than a long-term rise in inflation expectations. 42 Macro notes that yields moved higher as traders priced out expected easing from the Bank of England and the Fed. Looking at the broader international landscape, global bond markets are undergoing a notable hawkish pivot. Both U.S. Treasuries and European bonds are repricing as investors anticipate how central banks will react to these higher energy costs. According to 42 Macro, traders are now actively pricing out the easing we expected from both the Bank of England and the Fed. It is important to clarify that this move is a direct response to immediate inflationary pressures, rather than a fundamental shift in where long-term inflation expectations are headed. The compound points to a potential regime shift, noting that European equities have outperformed the S&P 500 so far this year. This is being driven in part by Europe's push for digital sovereignty, which aims to redirect tech spending toward local infrastructure instead of U.S. platforms. While they expect this momentum to continue through 2026, the source cautions that broad international ETFs can be suboptimal because they're often overweight in financials. They suggest looking at specific ADR names as the primary route for implementation. Moving to the macro tape, the February ISM manufacturing print came in at 52.4, which was a solid beat on market expectations. However, the data also shows prices jumping to their highest levels since mid-2022, signaling some unexpected heat in the sector. In tech news, Bella reports that NVDA is expected to launch a new inference-focused processor at next month's GTC, with OpenAI potentially serving as a major customer. To secure this hardware supply chain, NVIDIA is also reportedly making multi-billion-dollar investments into suppliers like Lumentum and Coherent. Finally, Tesla appears to be turning a corner in Europe, ending a 13-month registration decline with double-digit growth in France and Spain. According to data highlighted by Bella, Tesla is finally turning the corner in Europe, snapping a 13-month streak of registration declines. We're seeing double-digit growth across key markets like France and Spain, which suggests the demand slump in the region might finally be bottoming out. Our primary watch list is the AI hardware supply chain. We're tracking NVIDIA's GTC event next month, where a new inference processor is expected to debut, with OpenAI as a major customer. We are also keeping a close eye on component suppliers Lumentum and Coherent, following reports of strategic investments by NVIDIA to secure its hardware pipeline. More broadly, the S&P 500 has a technical floor at 6,800, though Morgan Stanley's 7,800 year-end target depends on oil avoiding a sustained historical spike. As the geopolitical story develops, Wall Street seems more focused on the price action than the headlines. Morgan Stanley is sticking with that 7,800 year-end target for the S&P, assuming oil avoids a sustained spike. For March, the key remains technical discipline and the duration of the Hormuz disruption. You'll find the full list of sources in the description. Subscribe for our daily macro and technical updates.